Ever feel like you're just swimming in financial news trying to figure out what actually matters? We get it. Today, we're going to cut through the noise. We're doing a deep dive into Hemas Holdings PLC, looking at their recent performance.
That's right. We've got their Q4 2024-25 interim report right here. It's pretty detailed, but our mission today is to pull out the really crucial insights. What's going on with Hemas? What are the key trends? And, what does it all mean for where the company is right now?
Okay, let's jump right in then. The big picture for the year ending March 31st, 2025 looks pretty good, actually. They reported cumulative earnings of ours, 8.1 billion. That's up, 31.9% from the previous year. Pretty substantial.
It is. And what's really interesting is that this big jump in earnings happened even though their total revenue actually dipped slightly compared to last year.
Oh, okay. So earnings up, revenue slightly down. What does that tell us?
Well, it strongly suggests they've either shifted focus towards things that make more profit, higher margin activities, or they become incredibly good at controlling costs.
Hmm.
Maybe both.
Yeah.
For you listening, it really underlines why you can't just look at the top line revenue number. You got to dig deeper.
Right, makes sense. Sounds like a combination of maybe operational tweaks and perhaps a bit of help from the broader economy improving
Choosing.
profitability.
Exactly. And we saw that pattern continue in the final quarter too. Revenue for Q4 was ours, 30.3 billion. That was down 3.5% year on year. But, and this is the key part, earnings surged, up a massive 63.6% to ours, 2.6 billion for the quarter.
Wow, 63.6%. Where did that boost mostly come from?
Primarily driven by their healthcare mobility sectors. Those performed really strongly. Plus, another big factor was a reduction in their net finance expenses, basically paying less interest or earning more on their cash.
Okay, so profit looks strong, but what about the overall financial health, beyond just the profit and loss?
It seems very solid. The report mentions strong operating cash flows. That's cash from their actual day-to-day business, which is vital. And get this, for the sixth year straight, Fitch Ratings confirmed their national long-term rating at AAA, Oka's Outlook Stable.
AAA, sixth year. That sounds like a really strong seal of approval, doesn't it?
It absolutely is. That consistent AAA rating really speaks volumes about their balance sheet strength and prudent financial management. It gives them and investors a lot of confidence. Very low risk profile indicated there.
And the market seemed to notice too. Their share price climbed 16.2% during the quarter. That's quite something when the overall market index, the ASPI, actually fell slightly by 0.8%.
A definite outperformance.
Plus, they announced a 5-for-1 share subdivision. We hear about stock splits, but what does that actually mean for, the average person listening?
Good question. Think of it like this. You have one share worth, say, 100 rupees. After a 5-for-1 split, you now have 5 shares, each worth 20 rupees. The total value you hold is the same, still 100 rupees, but the price per share is lower. The idea is to make the shares seem more affordable, more accessible, especially for smaller, local retail investors. And the report notes that post-split, the shares are indeed trading at a more accessible price level.
Got it. So a strong financial year overall, but what kind of economic backdrop were they working with? The report mentions the macro environment.
Yes, and it was showing some definite signs of recovery. Early days, maybe, but positive signs. The IMF's third review under the extended fund facility led to a disbursement of US $334 million. That's important support for stability and reforms.
And the overall economy grew. I think I saw that.
It did. GDP grew by 5.0% in 2024. That's after 2 years of contraction, so quite a turnaround. And per capita GDP, the average output per person, rose to US $4,516. So yeah, things moving in a better direction economically.
What about the currency and prices?
The rupee was broadly stable during the quarter, only depreciated about 1.3%. And those deflationary pressures, where prices were falling, started to ease up. That stability is generally helpful for businesses.
Okay. And government policy? Any impact there?
Well, the report mentions the government's budget trying to strike a balance between relief measures for the public and keeping finances in check. Fiscal discipline, they call it. Also important were increased foreign currency inflows from remittances, tourism picking up, exports improving. That helped boost reserves and ease import restrictions, which had been a real challenge.
Right, those import restrictions were tough. And interest rates. You mentioned lower finance costs earlier.
Exactly. Interest rates were coming down. The AWPLR, a key lending rate benchmark, was around 8.4%. Lower rates mean cheaper borrowing for companies like Hemas. Plus, lower energy tariffs help reduce operating costs, too. So yeah, a generally more favorable operating environment than perhaps the year before.
Okay, so a better economic climate setting the stage. Now, let's get into the nitty-gritty. How did Hemas's different business segments actually perform? Starting with consumer brands. Sounds like that one faced some headwinds.
It did, yes. Even with the better macro picture, this sector felt the pinch from earlier price cuts they'd made and also just really intense competition. So for the full year, revenue in consumer brands was down 9.4%, and for the quarter, it was down quite a bit more, 20.8%. Earnings also slipped slightly, 0.3% for the year and 5.4% for the quarter.
Down 20% revenue in the quarter. That's significant. But they kept their market share, you said.
Yes, interestingly, despite the revenue drop, they managed to hold on to their market share across most categories. Suggest brand loyalty is still there. The learning segment thinks stationary. Atlas brand did slow down, though. The report puts that down to inventory levels returning to normal after the peak season. And affordability seems to be a major theme. Lots of competition, especially in those value-for-money segments. Consumers are watching their wallets.
Was there anything boosting that learning segment?
There was actually a government program helping underprivileged students buy school supplies, and that apparently gave demand a bit of a lift. And Hemas didn't just sit back. They focused on efficiency improvements, productivity gains, optimizing their supply chains, likely trying to protect those margins as much as possible.
Okay. Can we break down consumer brands a bit more? Like home and personal care in Sri Lanka.
Sure. Within Sri Lanka, they saw volume growth selling more units in personal care and beauty. That's positive. But on the flip side, volumes declined in home care and personal wash categories. They were active with new product launches, too. New Goya fragrance variants, a deodorant spray. They relaunched Clogard salt toothpaste with a gum health focus, and a new Clogard toothbrush came out as well.
And something about a certification for their manufacturing arm.
Yes, Hemas Manufacturing got an Authorized Economic Operator, or AEO, Tier 1 certification from Sri Lanka Customs. Basically, it recognizes them as a reliable and compliant partner in international trade, which can smooth out customs processes.
Okay. What about their international operations? Bangladesh, for instance.
In Bangladesh, the picture was a bit brighter. Inflation started easing thanks to government measures there. Their value-added hair oil segment, Kumarika, EVA brands, saw growth in both volume and revenue. They did have to adjust prices upwards, though, to counter rising input costs like raw materials and the impact of the taka depreciating. But they seem to have managed that without hurting margins too much. And they expanded their product line, entering the male grooming space with a new Vibe perfume range.
Interesting. And back to the learning segment quickly, the Atlas brand. You mentioned the school calendar shift impacting comparisons.
Right, the timing change made direct quarterly comparisons a bit tricky. But fundamentally, Atlas held its #1 spot in stationery and actually gained traction in educational toys. Plus, they got named School Supply Brand of the Year again, for the 6th year running at the Slim Kantar People's Awards. That's a strong endorsement.
Definitely shows brand strength. Okay, let's shift gears to healthcare. You mentioned earlier this was a big driver of the overall earnings growth.
Absolutely. The numbers here are quite strong. For the full year, healthcare earnings hit ours. $4.3 billion on revenues of ours, $70.0 billion. And just in Q4, revenue was ours, $19.7 billion, bringing in ours $1.5 billion in earnings. Very healthy.
What drove that strong performance in healthcare?
Several things. Better working capital management, being efficient with their day-to-day cash. Prudent cost control, as we've seen elsewhere. And those lower finance costs definitely helped the bottom line. One point of note, though, the report mentions recent government gazettes on pharmaceutical pricing. Hemas is reviewing this thoroughly and working with the industry body, the SLCPI, on it, so something to watch there.
Okay. Within healthcare, how did the pharma distribution side do?
Performed notably well. Good growth in revenue and profit, and improved cash flow, too. And a really significant milestone for their manufacturing company, Morrison. They became the first in Sri Lanka to locally produce 2 important drugs, cilnidipine for hypertension and rivaroxaban, an anticoagulant.
Wow, local manufacturing of those. That's big news, isn't it?
It really is a big step for domestic pharmaceutical production. And there's potentially more good news. The government budget proposed exempting imported packing materials for pharma manufacturing from VAT. That would directly benefit Morrison's costs.
And the hospitals? How did they fare?
Also a positive story in the quarter. Improved profit margins and continued growth in both outpatient and inpatient numbers, people using their hospitals. They also made a significant investment, ours $1.0 billion in a new high-tech catheterization lab, a C8 lab, at Hemas Hospital, Wadala. That boosts their cardiac care capabilities significantly. And they picked up an award, too. Category winner in hospitals and medical labs at the Best Management Practices Company Awards 2025.
So, healthcare looking very robust. Now, what about the mobility sector? That covers maritime and aviation logistics, right? Sounded like a bit more of a mixed picture there.
Yeah, you could say that. Quarterly revenues were pretty stable, around Rs 487 million. But earnings saw a nice jump, up to Rs 266.7 million. Looking deeper, in the maritime segment, they saw more imports coming through the Port of Colombo, which is good, but that was partly offset by fewer exports and transshipments, and they're still facing pressure from falling global freight rates.
Okay, so ups and downs in maritime and aviation.
In aviation, a key development was Emirates starting a fourth daily flight between Colombo and Dubai.
Hmm.
That's a big 30% jump in seat capacity on that route. The cargo side of aviation apparently improved, but the passenger side, while volumes might be up, faced tough price competition, which likely squeezed the revenue they make per passenger, the yield.
So, even with those mixed dynamics, mobility still contributed positively to earnings overall.
Yes, it showed resilience and definitely added to the group's bottom line.
The report also briefly mentions another segment. Revenue there seemed to jump quite a bit in the last quarter.
It did, yes. Rs 27.0 million in Q4 FY25, compared to just Rs 4.1 million the year before. For the full year, it was pretty flat, though. It's a smaller part of the business, and the report doesn't give much detail. Could be specific projects or activities ramping up or concluding in that quarter. Hard to say without more info, but yeah, a noticeable quarterly spike.
Right. Now, it's clear Hemas puts a lot of emphasis on more than just financials. They talk quite a bit about ESG, environmental, social, and governance.
They do, and they seem to be making concrete progress. They report hitting targets for their Environmental Agenda 2030. Things like managing plastic waste. They collected over 1.1 million kilos of post-consumer plastic, improving water efficiency, and boosting their use of renewable energy up almost 39% quarter on quarter to over 12% of their usage.
That's quite specific. And environmental work beyond just waste and energy.
Yes, biodiversity conservation too.
Mm.
They're working with the Wildlife and Nature Protection Society, reintroducing some critically endangered endemic species into protected areas. Really valuable work. On the social side, their Hemas Outreach Foundation started building its 70th and 71st Piwara preschools. That program has been running for years. And their pharma distribution business helped fund 2 ambulances for the 1990 Suez Syria Emergency Service.
And the IATI Center.
Yes, the IATI Center, which helps children with disabilities, marked 5 years of service. They supported over 14,000 children, which is quite an impact. And even their brands get involved, like Diva, launching an online marketplace to support women entrepreneurs connected to their Diva Dathata Diriyak program. So it seems embedded across the group.
Okay, so a strong focus there. Finally, let's look forward. What's the outlook? What are Hemas plans?
They're clearly positioning for long-term growth. The strategy seems to focus on a few key areas: accelerating growth in larger emerging markets outside Sri Lanka, expanding into related business areas, adjacencies they call it, and using technology more to transform how they operate. They're also putting in place a new operating model. The aim there is to be more agile, more responsive to the market, and allow for sharper strategic focus.
That international expansion sounds like a big priority.
It does. They want to leverage Sri Lanka's national ingredients and their own expertise to reach global consumers. Southeast Asia and Africa are mentioned as potential areas for expansion, and they feel their strong financial position and healthy cash flow give them the foundation to make the necessary strategic investments.
So they're ready to invest in growth.
That's the message. They have a long-range plan guiding these investments, aiming to unlock new opportunities and ultimately deliver value to shareholders and other stakeholders. And speaking of shareholder value, they declared a final dividend of LKR 0.70 per share for the year. And as we discussed, shareholders approved that 1-for-5 share split.
Right. So wrapping it all up then, Hemas Holdings turned in a year with really strong earnings growth. Despite that slight revenue dip, healthcare and mobility were the stars. They benefited from a more stable economy, but also clearly focused on efficiency. And their strategy emphasizes international growth, technology, and ESG. The share split and dividend kind of underline that forward-looking stance.
Absolutely. It paints a picture of a company navigating challenges, but actively positioning itself for what comes next. And that leads to a final thought maybe for you listening to mull over. When you look at everything we've discussed, the different sector performances, the improving economy, the strategic priorities like international expansion and ESG, what do you think will be the most significant growth engine for Hemas in the coming years? And conversely, what might be the biggest hurdles or challenges they'll face in achieving those ambitions? It really makes you think about how all these different pieces fit together, doesn't it? The strategy, the market, the execution. It'll be interesting to watch.